We are discussing today block 2, cost of capital and investment decisions. Capital needed for the business is mobilized from various sources. The promoter of the business usually puts in his or her own money, and when the same is inadequate, he raises resources from other sources. When the promoter borrows money, he has to pay interest to the lenders. The same may be interpreted as the cost of capital. Simply because the promoter has put in his own money, we cannot presume that it is free. He should get some reasonable rate of return. The return he expects may be understood as the cost of capital for the money supplied by the promoter. The following are the basic characteristics of cost of capital. Cost of capital is the rate of return and not expressed in amounts. A firm's cost of capital represents minimum rate of return that will result in at least maintaining, if not increasing, the value of the firm. Cost of capital as a rate of return is calculated on the basis of actual cost of different components of capital. The components of capital we will discuss after some time. It is usually related to long-term capital funds. In operational terms, cost of capital in terms of rate of return is used as discount rate, used to discount the future cash inflows so as to determine their present value and compare with investment outlay. Components of cost of capital. Cost of capital thus has the following components. Return at zero risk capital, that you may say with the government bonds, etc. Premium for business risk, the type of business in which we are obtaining the cost of capital, and premium for financial risk. Means you may say the cost of capital may be put in the form of equation, the summation of return at zero risk level, premium for business risk, premium for financial risk. Formula: cost of capital equal to R0, that is return at zero risk level, B, premium for business risk, plus F, premium for financial risk. Business risk is the one associated with every business. In the usual sense, doing business is risky. In contrast, financial risk is the one arising out of the improper financial mix of resources employed to run the business. The three major components of this risk are credit risk, liquidity risk, and equity risk. The credit risk occurs due to the inability of the firm to pay off its creditors. Liquidity risk arises when the firm is not in a position to encash its assets in a limited time. Equity risk is associated with the fluctuations in the share prices of the company. The firm's capital comprises of equity and debt. The firm's overall cost of capital is the weighted arithmetic average of the cost of various sources of long-term finances. Take an example. Suppose a firm's capital structure consists of 30% equity capital and 70% debt, and cost of equity is 12% and cost of debt is 10%. The cost of capital for the firm will be 30 multiplied by 0.12. 30 is the proportion of share capital, equity, and 12% is its cost, and 70 is proportion of debt multiplied by 10% of its cost. It comes to 3.6 plus 7, that is 10.6%. In the form of formula, you may say average cost of capital, that is RA, equal to summation of P1 R1, proportion of first source of finance, cost of the first source of finance, plus some P2 R2 plus P3 R3 and so on. Classification of cost of capital. Cost of capital can be classified as explicit cost and implicit cost. Explicit cost is the discounted rate that equates the present value of incremental cash inflows with the present value of its incremental outflows, while implicit cost is the rate of return associated with the best investment opportunity for the firm and its shareholders. You may say that explicit cost is concerned with the raising of funds, while implicit cost is concerned with the utilization of funds. Average cost and marginal cost. Average cost is the summation of the different components of cost, as we have seen in the previous example. And marginal cost is the incremental summation of the individual components of the cost. Future cost of capital and historical cost. By the name itself, it is clear. Future cost is related with the future and historical cost is related with the past. Specific cost and combined cost. Specific cost of a particular component and combined cost of all the components combined together. Opportunity cost of capital. Opportunity cost of capital is the return foregone because of choosing present investment. For example, if the firm's capital was not invested in a particular business, or the owner has not invested the capital in the business, then that capital would have got some interest. That is the opportunity cost of the capital. Significance of cost of capital. The concept of cost of capital is central to the firm financial decision making. The very idea and action to start a business is based on the cost of capital. If the proposed business is not able to generate returns at least equivalent to that of cost of capital, there is no point in taking up such business. The following are a few such situations that turn cost of capital highly significant. Cost of capital provides the very basis for financial appraisal of new capital expenditure proposals. Cost of capital helps the manager to determine the optimum capital structure of the firm. Cost of capital serves as the basis for evaluating the financial performance of top management. Cost of capital also helps in formulating dividend policy and working capital policy. Cost of capital can serve as capitalization rate, which can be used to determine capitalization of the new firm. Computation cost of capital of individual components. There are four basic resources of long-term funds for a business firm. They are long-term debt and debenture, preference share capital, equity share capital, and retained earnings. Now we are computing the cost of each component of capital. First, cost of long-term debt. Cost of long-term debt represents the minimum rate of return that must be earned on debt financed investments if the firm's value is to remain intact. The formula for computing the cost of long-term debt at par is KD, cost of long-term debt, equal to 1 minus T. T stands for tax rate, multiplied by R means interest rate. For example, suppose the tax rate is 30%, then 1 minus T, it will be 0.7 multiplied by interest rate, say 10%. This is cost of debt. In case debentures are issued at premium or discount, the formula is as follows. Cost of debt after tax equal to cost of debt after tax is denoted by KD equal to 1 upon NP. I upon NP. I is annual interest payment and NP is net proceeds received by the holder on redemption, and T is tax rate. Therefore, cost of debt after tax is annual interest payment divided by net proceeds received by the holder on redemption and multiplied by 1 minus tax rate. For computing cost of redeemable debt, the formula for cost of debt will be cost of capital, that is KD, equal to I, annual interest payment, plus RV, redeemable value of debt at the time of maturity, plus SV, sales value less discount and flotation cost, divided by N, number of years to maturity, and multiplied by 1 minus T. T is company's effective tax rate, and whole divided by RV plus SV divided by 2. And RV, I have just told, redeemable value of debt at the time of maturity, and SV is sales value less discount and flotation cost. In case of underwriting and other issuing cost, they are adjusted in the same way as discount is being adjusted in net proceeds and other calculations. Now the second component, preference shares. Cost of preference share capital represents the rate of return that must be earned on preference stock to keep the earnings available to residual stockholders unchanged. Cost of preference shares can be estimated by dividing the dividend stipulated per share by the current price of the share. Or you may say, in the form of a formula, cost of preference shares equal to dividend divided by face value minus issue cost. But now the companies can issue only redeemable preference shares. Means the value method of cost of preference share capital is similar to that used for cost of debt capital. Means the previous one. The only difference is that in place of interest, which we have stated in the formula, dividend on preference shares is used. Cost of equity capital. Just like the other sources of capital, equity also has its own cost. Simply because the owner has brought in the capital, we cannot presume it to be free. Methods of computing cost of equity capital. The following are the approaches to the computation of cost of equity capital. The first method is earning price ratio method. Cost of equity capital is measured by earning price ratio. Symbolically, cost of equity capital, KD, or you may say KE, equal to E0 upon P0. E0 is current earning per share and P0 is current market price per share multiplied by 100. EP plus growth rate method. The formula is as follows. Cost of equity, KE equal to E0, current earning per share, multiplied by 1 plus B raised to Q, growth factor, where B is the growth rate as a percentage and is estimated for a period of 3 years. If the period is 4 years, it will be I plus B raised to 4 and so on. Divided by P0, current market price per share. DP ratio method, cost of equity capital is measured by dividends. And the formula for cost of equity capital, that is KE, is dividend per share divided by market price per share and multiplied by 100. Next is the method which is more realistic. As it considers future growth in dividends and it considers the capital appreciation. This method assumes that the value of a share is the present value of all anticipated dividends, which it will give over an infinite time horizon The firm is here viewed as a going concern with an infinite life. Thus, P0 means current price of the equity share equal to D1, dividend expected at the end of first year, divided by KE, that is risk adjusted rate of return expected on equity shares, minus G, or constant annual growth in dividends and earnings. Or in other words, you may say cost of capital KE equal to D1 upon P0 plus G. Realized yield method. One of the difficulties in using DP ratio and EP ratio for finding out cost of capital is to estimate the rate of expected return. Hence, this method depends on the rate of return actually earned by the shareholders. The limiting factors to the use of this method are the additional conditions that the investor's expectations do not undergo change during the study period. No significant change in the level of dividend rate occurs, and the attitude of the investors toward the risk remain the same, as these conditions are rarely fulfilled. And last one, securities beta method. William Sharpe introduced the concept of beta to reflect the risk level of an individual security. He indicated that the expected return, which can be considered as the cost of equity capital, is comprised of two components, risk-free rate and risk premium. Summation of these two is cost of capital. The risk premium is arrived at using the beta of the security. Thus, beta of security is the risk attendant to that security. Cost of retained earnings. Corporate managers and some analysts normally consider the funds retained in the firms as cost-free funds. This is not true. It definitely costs the shareholders something, and this is an opportunity cost representing sacrifice of the dividend income which the shareholders would have otherwise received if invested the same elsewhere to earn a return thereon. Thus, the minimum cost of retained earning is the cost of equity capital. Or you may say formula, cost of equity capital based on dividend growth methods multiplied by 1 minus shareholders tax rate and again multiplied by 1 minus percentage brokerage cost. Weighted cost of capital. Weighted cost of capital, also known as composite cost of capital, overall cost of capital, or weighted marginal cost of capital, is the average of the cost of each source of fund implied by the firm, properly weighted by the proportion they hold in the capital structure of the firm. The weights to be employed can be book values, market values, and again these values may be historic or target. Now we come to the second part of today's discussion, investment appraisal methods. A proper decision making in capital investment is one of the most crucial areas of financial management. The successful running of any business firm is dependent on the allocation of resources in such a way that benefits or the highest feasible returns are realized. The capital budgeting is the word used in financial management to describe the investment decision. Investment decisions are driven by the question of whether increasing capital assets today will boost revenues enough to cover costs in the future. Need for investment decision. The necessity for investment decisions arises in order to achieve the firm's long-term goal, which may be survival or expansion, maintaining market share, and maintaining leadership in a specific area of economic activity. Factors affecting investment decisions. The following three types of data are needed to make the best investment decision. Calculate the proposed project's capital outlay and project earnings. Capital availability and cost cutting considerations, and a proper set of criteria for selecting projects for execution in order to maximize the return. Means first you have to collect this data. Only then you will be able to take investment decisions. Types of investment proposals. Long-term financial investment may be required for the following reasons. Expansion of operation means output. Diversification in operations or starting some other lines of business. Replacement, modernization of plant and machinery, and research and development, R&D. Investment appraisal process. The following need to be considered before appraisal is taken up. The amount and timing of initial investment outlays, amount and timings of subsequent investment outlays, economic life of the project, salvage value at the end of the project, and the amount and timing of cash inflows. The investment appraisal methods or techniques for evaluation of investment proposals will help the company to decide the desirability of investment proposal depending upon their relative income generating capacity and rank them in order of their desirability. These methods provide the company a set of norms on the basis of which either it has to accept or reject the investment proposal. The appraisal method should possess several good characteristics, which are: it should help the company to rank the investment proposal in order of their desirability. It should provide a technique for distinguishing between an acceptable and non-acceptable project. It should provide a criteria to solve the problem of choosing among alternative projects. It should recognize the importance of time value of money. That is, bigger profits are preferable to smaller ones, and early benefits are preferable to the later benefits. It should provide the criteria for the selection of investment proposals. It should consider the pattern of cash flows. Now, these methods of mainly of two types: traditional method, which includes payback and accounting rate of return, and discounted cash flows method, which include net present value, internal rate of return, and profitability index. The first method, payback period. Payback period, here in the formula P equal to E, stands for number of years immediately preceding the year of final recovery, plus B stands for the balance amount still to be recovered, divided by C stands for cash flow during the year of final recovery. For example, suppose in a machine the investment is rupees 5 lakh. The recovery in the first year is 2 lakh. In the second year it is 1 lakh. In the third year it is 1 lakh 50,000. Means in 3 years the recovery has been 4 lakh 50,000. In the fourth year the cash flow is 2 lakh. So here in the formula E is 3 year, B is 50,000 and C is 2 lakh. Therefore, payback period will be 3.25. And in payback, we must keep in mind the shorter the term, the better is the project. Accounting rate of return. This method of calculating the rate of return on investment is based on companies' financial accounting methods for calculating annual earnings. After depreciation and taxes, the net annual profits are calculated. The average of annual earnings so obtained is calculated based on the project's life cycle in number of years, and the accounting rate of return, also called the average rate of return, is defined as profit after tax divided by book value of the investment. Both these techniques, traditional techniques, overlooks the time value of cash flows. They also does not consider the scrap value of an asset or project at the end of its useful life. Now, modern techniques, discounted cash flow method. DCF provide a more objective basis for evaluating and selecting an investment project. These methods consider the magnitude and timing of cash flows in each period of a project's life. There are 3 different DCF methods: net present value approach, IRR, internal rate of return approach, and profitability index. Net present value method, which is actually based on the compound interest formula. The formula for compound interest is principal multiplied by 1 plus r divided by 100 raised to n. This is here. For example, if we invest rupees 100 for 1 year at 10% rate of interest, then after 1 year this 100 will become 110. In the reverse mode, if we say, it is also possible to say that what was worth rupees 110 is now only worth rupees 100. When the compounding formula is used to calculate present value of a future stream of income over a number of years, the formula is reconstructed as present value equal to P, amount to be raised in future, divided by 1 plus R, rate of interest raised to n, number of years, and whole divided by 100. Internal rate of return, second method. The internal rate of return is another way for evaluating investment ideas that falls within the discounted cash flow method. Using this method, we can calculate the discounting rate at which the sum of all future cash inflow PVs equal the proposal's current cash outflow. And last, profitability index. When using the internal rate of return approach, a proposal may be rejected if the IRR is lower than that of the other. Yet the former may not be a terrible proposal if the NPV is calculated using the target rate of discount. And here profitability index comes into picture. Depreciation, tax and inflows. It is important to note that depreciation is not included in discounted cash flow calculations. The DCF approach is fundamentally based on inflows and outflows of cash, and not on the accrual concept of revenues and expenses. Depreciation does not involve any cash inflow, therefore it is not taken into consideration. Limitations of appraisal technique. The methods for valuing investment appear to be precise. However, it must be understood that an investment proposal's genuine worth can only be approximated. The final findings are based on estimated factors, which must be kept in mind at all times. The degree of impartiality and reliability of the input data would determine the outcome's dependability to a considerable extent. Now we come to the third part and last part of today's discussion. Management of working capital. Effective financial management includes, among other things, the proper management of cash invested in a business. These funds can be used for a variety of purposes. Significance of working capital. You will be hard pressed to find a business that does not require some form of operating capital. The working capital of a company is its lifeblood. In fact, without appropriate working capital, any organization, whether profit-oriented or otherwise, will be unable to carry out day-to-day company activities. The operating cycle or working capital cycle is the period of time between the procurement of raw material or product and their conversion into cash. The following figure depicts the sequence of events that generally occur throughout an operating cycle. The monies invested in activities are recycled back into cash as per the operating cycle. The longer the conversion period, the longer the operating cycle. Obviously, the shorter the operating cycle, the lesser the amount of money that is invested for various intermediate activities. Here, one figure of operating cycle. Starting from cash, purchase of raw materials, parts and components, production, when purchase is there, creation of accounts payable or creditors, payment to creditors, during production, manufacturing operations, added cost, wages, salaries, fuel, supplies, power, etc. Office selling distribution expenses, then warehousing of finished goods or merchandise, sales of finished goods or merchandise, which in turn creation of accounts receivable or debtors, receipt from debtor. Now again it has come to the cash. Or you may say operating cycle starts from cash and ends also in cash. Means the period in which cash will again be converted into cash is known as operating cycle. Concept of working capital. Two concepts are normally used, the gross and net concept of working capital can be considered two fundamental aspects of working capital management. Both notions are operationally important to management, thus neither should be overlooked. The gross idea of working capital stresses the quantitative aspect, while the net notion emphasizes the qualitative. Gross means, gross working capital means only current assets, whereas net working capital means current assets minus current liabilities. Kinds of working capital. The working capital is classified ordinarily into two categories as follows: fixed, regular or permanent working capital. Means that part of working capital which will always remain in the business. Variable, fluctuating, seasonal, temporary or special working capital, which arises due to some special circumstances. Fixed working capital. The operating cycle, which is a continuous process for creating items, is linked to the need for existing assets. However, the amount of money invested in current assets may not always be the same. Depending on the quantity of production, the demand for current assets investment may increase or decrease over time. Regardless of the number of operations, a certain minimum level of current assets is always required for the company to operate. Since this level of current assets investment is permanently tied up in the business, it is referred to as permanent, fixed, or regular working capital. It is permanent in the same way as investment in the firm's fixed assets. If we depict this fixed working capital on a graph, the line will go as this. Fluctuating working capital. The need for working capital over and above the permanent working capital will vary depending on changes in production and sales. Seasonal fluctuations, as well as unusual or expected circumstances, might affect the requirement for working capital. Additional operating capital may be required to deal with fierce market rivalry or other unforeseen events such as strikes and lockouts. Additional operating capital may be required to fund any special advertising campaigns aimed at raising sales or other promotional activities. This additional working capital is called fluctuating, or other words, variable, seasonal, temporary, or special working capital because it is required to support changing scenario. If we depict this fluctuating working capital on the graph will be like this. Components of working capital. We have already noted that working capital has two components, current assets and current liabilities. The current assets comprises of several items and the typical one are cash, the most important component without which no business or any business is not possible. Or you may say even without cash, the day-to-day life is not possible for any person. Second component is accounts receivable or sundry trade debtors. Third is inventory. Inventory may be of raw materials, store supplies and spares, work in process, finished goods, and advance payments for all these. And temporary investment of surplus fund or marketable securities. The typical items of current liabilities are goods purchased on credit, expenses incurred in the course of business, for example, wages, rent, etc., which are not yet paid. Temporary or short-term borrowing from banks, financial institutions, or other financiers. Advances received from the parties against goods to be sold or delivered or as short-term deposits. Other current liabilities such as tax and dividends payable. Importance of working capital management. Working capital and risk management are of great importance to both internal and external analysis because of their direct association with a company's day-to-day operations. Working capital deficiency or mismanagement is becoming widely recognized as the major cause of most business failures. Working capital management is both a task and an opportunity for a financial manager who wishes to play a key role in his company. Determinants of working capital. Nature of business. For example, if there is a industry, then working capital required will be too much. But if there is a business of life insurance agent, the investment in fixed assets will be nominal. The and also in the working capital it will be nominal. Size of business. Larger the size, larger investment in working capital. Manufacturing cycle. If cash is converted into cash. After a long time, the large amount of working capital will be required. Business fluctuations, booms and depressions, production policies. If you want to keep certain extra goods, you have to invest in the working capital. Turnover of circulating capital, credit terms. If they are increased for the debtors, working capital requirement will increase. But if they are increased for the creditors, working capital requirement will decrease. Growth and expansion activities, operating efficiency. Faster you realize your debtors, it will be the lesser need of working capital. Price level changes. If they increase, working capital requirement will also increase. Approaches to managing working capital. In general, there are two ways to working capital management in a business: the traditional approach and the operational cycle method. Traditional or conventional approach, this strategy entails properly and economically managing the various components of working capital so that neither idle funds are nor is scarcity of fund exists. Operating cycle approach, working capital is determined using this method by the length of the operating cycle and the operating expenditure required to complete it. The number of days engaged in each stage of the operating cycle, from the acquisition of raw materials through the realization of proceeds from debtors, is measured in days. The required operating expenses for an operating cycle, computed based on operating expenses required for a year, will be the optimal amount of working capital. Most organizations in India used to utilize the traditional strategy, but this is changing as the operational cycle approach becomes more popular. This strategy is commonly used by banks when extending credit to their customers. Measuring working capital. The factors outlined in the earlier section have an impact on the size of a company's working capital. How to identify or estimate the amount of working capital that an enterprise would require is a difficult question. Let us go through the following example to understand how the quantum of working capital required is calculated. I have given one illustration. I am discussing it. Here you have been given selling price is rupees 2000 per tricycle and cost shows materials etc. 40%, labor 30%, overhead 10%. Then the total cost per tricycle will be 2000 multiplied by 80 upon 100, or 80% of 2000, that is 1600. 80 is 40% material, 30% labor, and 10% other expenses. Now, one by one calculation. Cost of materials. It is given here, the monthly production is 5000 tricycles. So we are calculating it for 5000. Cost of raw materials 800. 40% of 2000. And raw materials, parts and components are expected to remain in the stores for an average period of 1 month before issue to production. means it is calculated for 1 month. 5,000 multiplied by rupees 800 multiplied by 1, it is 40 lakhs. In case of finished goods, 5,000 multiplied by 1,600, that is the total cost of production. And it is given here that finished goods are likely to stay in warehouse for 2 months. Therefore, it is calculated for 2 months, that is 160 lakhs. Work in process. The same figure, 5,000 multiplied by 1,600, and it is given here that each unit of production will be in process for half a month. Therefore, it is calculated for half month or 40 lakhs. For debtors, it is given here half of the sales are likely to be on credit, and debtors will be allowed 2 months credit. Therefore, 50% of sales or 5,000 multiplied by half into cost 1,600 for 2 months, it is 80. Means total of current assets is 320 lakhs. Now current liabilities. Creditors, 5,000 multiplied by 800, that is the cost of raw materials. And it is given here, credit period allowed by suppliers is 1 month, therefore it is calculated for 1 month or 40 lakhs. Wages, 5,000 into 600, that is the 30% of 2,000. And for wages, it is given lag of payment to labor is 1 month. Therefore, it is calculated for 1 month, that is 30. Overheads, 5,000 multiplied by 10% of 2,200, and here it is given that 50% of overhead consists of salaries of non-production staff. Therefore, half of it for 1 month it will be 5 lakhs. Total current liabilities will be 75 lakhs. And net current assets or net working capital requirement will be 245 lakhs. It is given here, allow 20% to your computed figure for buffer cash and contingencies. Therefore, 20% of 245, 49 lakhs is added to it. And average working capital requirement will be 294 lakhs. The same calculation I have given here for your ready reckoner. Working capital management under inflation. To maintaining the current level of activity, it is necessary to keep an eye on the rising need for capital. In times of inflation, this becomes even more important. The following strategies can be used to keep working capital needs under control during inflationary period. Use of substitute raw materials, appropriate motivational tactics, and controlling the cost. The increasing need to increase working capital will be mitigated. The payment to creditors on time builds a positive reputation. Efficiency criteria, 2 points. Whether creditors have enough confidence in company and whether or not the highest potential inventory turnover is attained. Whether customers are given reasonable credit, Obtaining appropriate credit from supplier is contingent on company's position, and these are adequate safeguards. How to measure the efficiency? Current ratio, which is current assets upon current liability. Quick ratio, which is liquid assets upon current liability. Cash to current assets, ratio between cash and current assets. Sales to cash ratio. Average collection period, which is in number of days. Average payment period. Inventory turnover ratio, relationship between sales and average inventory. Working capital to sales, and working capital to net worth. That's all. Thank you. Namaskar.